You're listening to Confessions of a Bookkeeper, where we look at businesses through the eyes of their books. My name is Mark, your Chief Bookkeeping Officer, and I spent years cleaning up and reviewing some, let's say, interesting books. This story has been blended from a few real experiences to protect everyone's privacy, but what happened and what we learned from it is something every business owner can potentially relate to. Some background here: my client's business is a law firm, high volume, fair amount of revenue. And when I first spoke to the CFO during an exploratory consultation, he struck me as the kind of person who's seen a lot of balance sheets, right? He's smart, direct, and composed. But underneath it, like on a different layer, you could hear something in his voice. It wasn't a panic, but it was definitely an urgency, a kind of pressure you only sense when a business has been sliding for a while. He told me right away that he couldn't trust his books he just inherited because this was his first month of the job. And when a CFO says that, it's never just about the numbers. It's about what the numbers represent: the culture, the systems, the people behind them. Being quite new to the firm also implied a business transformation was underway. I just wasn't sure of that scale of that transformation. It usually starts with some C-suite shakeups and trickles down to the respective departments, or sometimes it could be company-wide. He didn't describe the office and staff though. He didn't need to. You can imagine the scene. A team under strain, routines that used to work no longer holding up, and a quiet tension in the air. And if you're a new executive walking into that, the questions start forming immediately in your head, like, how did it get this way? What's broken? And how do I make sure it doesn't happen again under my watch? You could hear all of that in his voice. He was doing everything himself in the accounting department, writing checks, running deposits, reconciling accounts manually. That's not what a CFO should be doing. Not because it's beneath him or beneath the title, but because if the person at the top is stuck in the manual grind, it means the systems underneath them aren't working and maybe haven't been working for a while. Either he doesn't trust the in-house team or hasn't developed a rapport with them as of yet. Still, he did something smart. He asked for help. And he knew he didn't need more spreadsheets. He really needed just, more structure. And that's when we came in. Outsourced bookkeeping brings something that doesn't show up on a profit and loss. It's continuity of service. That stability has real value. It's what keeps a business from collapsing every time a staff member leaves. But it's not just about continuity. In our case, it's about specialization. We understand law firm bookkeeping, and we've also worked deeply in other regulated fields like medical practices, so we know what compliance and oversight looks like in the real world. When we looked at the books, the problems were immediate. Multiple IOTA accounts that had never been properly reconciled, client costs sitting on the P&L instead of the balance sheet, and probably the most egregious, settlement checks from insurance companies recorded as income, even though that money belonged to the clients. The firm was millions in debt and current liabilities, and with the P&L misrepresenting income, they couldn't get financing. The numbers didn't tell the truth, and no lender wants to fund confusion. We rebuilt everything from the ground up, re-importing years of transactions, moving client settlements to the balance sheet, treating case advances as assets, setting up proper three-way reconciliations to satisfy the state bar. Slowly but surely, the books started making sense again. Once they did, leadership could finally see clearly enough to act. The CFO formalized a COO position. Before that, they'd been using a consultant as an interim operations chief. Quite expensive and not so effective. When the new COO came on, he brought in a lot of experience and a lot of urgency like the CFO had. The business needed both. He came from another firm in a different practice area and understood both the business side of law firms and the human side. His first question to us was exactly the right one. How familiar are you guys with law firm bookkeeping? We walked him through our approach, how we use QuickBooks to manage both operational and trust activity in one account, and how check writing through QuickBooks gives real-time visibility into outstanding items. I think he got it immediately. Then over the next few months, the book started showing signs of change. You can tell a lot from the spending patterns of a client. New software subscriptions, consulting fees for training, little clues that leadership was trying to modernize how they handled the business. As outsourced bookkeepers, we're not in the room when these decisions happen, but we see their fingerprints. The new vendors, the new payees, small shifts in recurring costs. You start to read the story in the data. One big shift stood out: a practice management software change that costs around $15,000 to implement. That's a big decision to make when the firm was still kind of underwater and definitely running in the red. You don't make that kind of investment unless you're really serious about fixing deeper problems, and I can only imagine what it took to convince the owner to make this change. The old software was outdated, inefficient for case managers, and didn't give the clients the kind of onboarding experience the firm wanted to deliver. And in law, onboarding is everything. It's a client's first impression of whether they can trust you. That's usually what drives a firm to switch systems. Not the back end reports, but the front end experience. Because if you're a client signing away, 25 to 33% of your settlement, you want to feel like you're getting more than just legal work. You want to feel taken care of. That's where the software comes in, giving the process a higher end white glove feel right from that first phone call. And that kind of experience doesn't just happen. It takes the right people. Finding staff who can bring the bedside manner to a high stress business like a law firm is difficult. Law firms can be firm by nature. The staff has to balance that out, though, with empathy. And the COO understood that. And it showed in the hires. During that time, marketing spend dropped sharply. It had been their biggest cost by far, sometimes far exceeding the revenue itself. And marketing is addictive. It's one of those expenses that feels impossible to cut because you think that ads are your business. You start believing the spend itself is what keeps revenue alive. But once you're hooked, you stop measuring what's actually working. Things like word of mouth, client referrals, or your reputation. Those things don't show up in a dashboard, so they get ignored. Cutting marketing felt dangerous, but it was necessary. And to balance that, the firm started spending more on people. Payroll dipped briefly, then climbed again. They issued company credit cards to each case manager so we could properly track case-specific costs. It's the same logic as construction companies giving project managers cards for their sites. The people closest to the work understand the costs the best. Over the next 6 months, payroll grew by roughly 30%, while ad spend kept falling. Month to month, you couldn't always see the benefit of these changes. Law firm revenue is quite unpredictable, but over a year's time, the results were clear. Revenue was up 40% year over year. Millions in losses turned into break even. And that was the target. Not profit, just stability. A company that could finally sustain itself without the owner constantly infusing cash. A break even isn't glamorous, but it's a huge morale win. From our side, we want to change unfold through the books. The smooth cash flow, the balanced payables, the absence of panic spending. That's what a turnaround looks like in numbers, not a miracle jump, but the slow, steady return of balance. Now, not every business has that kind of control. Professional services firms can restructure, they can pivot, but some industries like restaurants can't. Restaurants are some of the hardest things to watch as a bookkeeper. Once the slide begins, it's rarely recoverable. The margins are tight, the timing unforgiving. A restaurant lives or dies by decisions made right at the beginning. The location, the rent, the menu, the pricing. The food doesn't wait. It expires. If you commit to fresh, high quality ingredients, you need the volume to move them. If the volume isn't there, you waste product. It erases profit. So you cut costs, but every cut you make changes the customer experience. You see it on paper. Food costs go down, gross profit spikes, only for a brief moment. It looks like things are improving, right? But that spike usually means smaller portions, cheaper ingredients, and less repeat business. You can't cut your way to loyalty. And that's why restaurants have such a hard time turning around. They're fighting time, perishability, and perception all at once. A service business can reallocate. A restaurant can only react. But across both, there's a shared truth. The earlier you listen to what your numbers are telling you, the more time you have to fix the story. For this law firm, clarity came first, then structure, then consistency. Those three things save them. The books don't predict the future, but they do show you what kind of future you're building. And I'll end this one by saying, while I'm the bookkeeping manager, none of this would have been possible without my team, a group of really skilled accountants who most people would just call bookkeepers. They're the ones who make transformations like this possible every day. And these are Confessions of a Bookkeeper. Thank you for listening.